All right. Everyone should be able to see my screen now. Good evening, and thank you all for joining the Wealth Mindset and Real Estate Investing virtual meetup. My name is Chris Price, and I'm the host of the Wealth Mindset and Real Estate Investing Meetup. For those of you who have not had the chance to meet, thank you guys for joining it live. For those of you who will be watching on the recording that's posted on our YouTube channel, thank you for continuing to tune in as well. I'm also, in addition to being the host of the Wealth Mindset and Real Estate Investing Meetup, I'm also managing partner at Boost Capital Group, and I'm also the CEO and co-founder of Red Fox Multifamily. So this evening, we're going to talk about thriving beyond the election, real estate strategies for wealth building during presidential transitions. But before we get to that, I want to take a brief moment for a little bit about our sponsors of the Wealth Mindset and Real Estate Investing virtual meetup. But first, let me get into who we are and what we do. So the Wealth Mindset and Real Estate Investing meetup is open to all who are interested in growing generational wealth through passive real estate investing and increasing their financial intelligence. This meetup is for the busy professionals and retirees across various industries. The individuals in the group make a good living and and have discretionary income to invest in real estate for its proven wealth building power, but don't have the time, skill set, or network to do it at speed and at scale. This meetup focuses on helping us all grow our wealth mindset by leveraging how to build and preserve wealth while developing and maintaining an abundance mindset. This meetup will focus on multifamily real estate investing as well as other proven ways to build wealth through real estate through passive investments. And this is sponsored by Red Fox Multifamily. Red Fox Multifamily helps pharmaceutical and life science industry professionals diversify their portfolios, add passive income, and get all the other perks of real estate investing without having to do any of the work themselves. Red Fox Multifamily partners with passive investors to buy commercial multifamily real estate based on vetted opportunities we get access to from our trusted network of top operators in the best markets throughout the country. Partnering with Red Fox Multifamily makes investing in real estate completely hands-off, allowing investors to add passive income, build equity, and save on taxes, all while being in an investment vehicle that's backed by a hard asset. And then finally, for our sponsors, we're also sponsored by Boost Capital Group. Boost Capital Group, their vision is to become the premier partner for busy professionals and entrepreneurs seeking to build and preserve their wealth through passive real estate investments. So as far as tonight is going to go, we'll go through some logistics as I always do for those of you who are attending live. If you can, please mute your lines to make sure that you don't pick up any background noise when you're not speaking. If you can hold your questions to the end, of course, I do know that there may be burning questions. Please feel free to ask them as needed. This presentation is being recorded. And then also note that this material does not constitute an offer or a solicitation to purchase securities. This is just information and it should not be construed as business, financial, or legal advice. And then finally, here, before we get into the content, I'm always interested in connecting with people. I love building relationships with folks, getting to know other people in this space. It's an awesome community to be a part of. I've met so many great people as a part of being in the real estate industry and have built my network. And so everyone is just so giving and team oriented. I appreciate that, and I'd love to make sure that I can continue to share that with those of you who are interested in connecting with me. So find me on social media. You can scan the QR code, or you can also shoot me an email at chris@boostmycapital.com. So let's get into tonight's presentation, which and afterwards, if there's time and a desire, we can certainly invite folks for Q&A and just this open discussion. So tonight we are talking about thriving after the election. There's no secret. We had a big election this year, and a lot of a lot of energy was put towards that. So how do we talk about thriving after the election? From a wealth mindset and real estate strategies for your family's future. With the election behind us now is the time and is the perfect time, I would add, for us to refocus on what matters most to us all, and that is building a secure financial future for your families. So I'm glad that you're all here. This is not intended, it's intended to be positive. It is not intended to be partisan at all. And we plan on taking some dive into how a wealth building mindset and passive real estate investing can provide lasting security and growth. In this session, we're going to cover a few key things. We'll cover real estate as a wealth tool, why passive real estate investing is a powerful way to create income stability and also long-term growth, regardless of the political shifts. We're also looking to be able to help people adopt a wealth mindset that, I shared on previous sessions or previous episodes of this show that wealth mindset and real estate investing was very intentional in terms of the name, because on my journey here, growing my wealth mindset was something that was so important to me, and something that I value very much in terms of the person that I've evolved into, and that I've become and I continue to grow and develop as well. And I think that's important for all of us to be able to do. And you all being here tonight and investing this time to be able to grow your wealth mindset just speaks a lot of you. And of course, for those of you who are catching the recording as well. We also plan on talking about how shifting focus from, the incessant news cycle and social media and all of those things, and shifting our focus from that to more productive actions can strengthen your financial journey. And we also want to talk about building financial unity, connecting in this community, with all of us, with like-minded individuals. This brings people together, and people who share that commitment to financial independence and resilience, irrespective of who's in office or who's not in office, or what's happening at work and what's not. All of those things are things that you cannot necessarily control, and so but you can control investing in yourself and being in the right communities that can help enrich you, so that you can take care and be the best person to take care of your family. And so whether you're candidate one or not, that's not the point of this presentation. We're here to help and to talk about how to transform this moment into an opportunity for growth and financial empowerment, which is in everyone's interest at the end of the day. So we plan on talking about a few key things here, addressing the concerns from my perspective. When we think about how we're approaching this, we understand that in any election cycle there is uncertainty following elections, and how what policies are going to change, and how is this going to affect me and my personal economy. Our goal is to be able to talk a little bit about this and provide some clarity and direction on these items. And then when we talk about this, also we also recognizing that we are one United States of America, and we have to rise above the division when we're focused with a wealth mindset. As an investor, we want to be very thoughtful about how we focus on our financial well-being. This is, not the political divides. And I will tell you, it will be easy for people to go either way, for people to spike the ball, so to speak, or if their candidate won, or for people to reject everything else that's going on if their candidate lost. And the idea about this is to really make sure that we rise above this and we really focus on the target at hand. So, there was an interesting point that was brought up to me earlier this week, and the point that was made, and that I thought about and reflected on was, regardless of the situation, whether your candidate wins or won or lost, when you look back 4 years from now, will you be in the same spot that you are today, or would you have advanced for yourself and for your family? And that's the drive and the motivation that we all need to be operating from, to really truly make sure that we are investing in ourselves and investing in our financial well-being for our families and for our future. And then taking advantage of opportunities. Times of change, they present these unique chances for growth, and transformation. Let's make sure that we explore that throughout the course of the next few slides. So you guys know that the focus of the content here is real estate investing. And the primary reason behind that is because real estate, it has been and always will be one of the most tried and true investment vehicles that has made more millionaires and billionaires than virtually any other investment that we know in this country. That is something that is so important, and so we focus on that intentionally. And there's so many different ways to tap into real estate. There, of course, is active investing for those people who prefer to be hands-on and want to, renovate homes, and they want to put tenants in those units, and they want to, do all of the heavy lifting and getting the financing secured, and they want to do all of those things and roll up their sleeves to get it done. That active investing is probably more your speed of what you want to do. But for all of the people out there that love the idea of real estate investing, but they're not necessarily interested in trading that time and doing all that work to be able to make a profitable asset and build a portfolio to do so, there is a way to for you to be able to tap into these things. So, and that is through passive real estate investing. When we talk about passive real estate investing, we want to make sure that we understand that real estate provides some stability during uncertain times. The fundamental message that I want to make sure that I offer to everyone is that real estate in particular, that roof over our heads, is one of the most essential things in our lives. Food, water, shelter, and Maslow's theory, as we all have heard before, those fundamental needs, housing is at the top of the list. And so when you think about that, and the how it connects from an economic perspective, it offers some of the benefits that we all are seeking from an investment standpoint, that cash flow, and then the opportunity for those assets to appreciate over time. And then when we talk about wealth building, passive investing allows us to build wealth without active management. As I mentioned before, and I have direct experience with this in managing a small single family portfolio before getting into passive investing and myself. Taking those phone calls from tenants. Well, the one tenant that we had a phantom leak in a dishwasher that called me away from my family in an evening, and there was nothing going on, and that continued on for multiple months. And so these types of things, and that wasn't necessarily the desired experience that we had. Or I can speak to an experience that we had where we had a tenant, and again, the good far outweighed the bad. So don't mistake me here. But these stressors that came with active management were certainly not fun. Let me put it that way. And so when we think about things like getting having a tenant that we had in one of our properties ghost us for months, and after when we had to evict them, and only for them to leave the property damaged, and then we had to go to court systems to garner their wages to be able to recoup some capital after we had to pay the lawyer fees. So these are things for active people that are actively investing and managing properties. You may have that experience. If you haven't, it is something, I'm not wishing it upon you, but it's more than likely that these things are just around the corner from you. It's just a part of managing an active portfolio. But when you are passive investing, you get to relinquish all of those things to the pros so that your money is working for you. And then when you think about long-term security, real estate investments can secure your family's financial future. Because they offer this opportunity for generational wealth transfer opportunities. So what do I mean by that? There is opportunity. There are very few assets that you can acquire where you can use leverage or debt from a bank to be able to uh, uh, purchase that asset, and for you to be able to take advantage of adding improvements from that property, adding its value to it, reducing the expenses on that property, and being able to capitalize on that to be able to sell that property, and all of the proceeds, your proportional share of those proceeds will come to you. There's very few assets where you would be able to do those things, and real estate investing, even as a passive investor, provides those types of opportunities. So when we think about changes and thriving during presidential transitions, of course, there are a number of different things that we want to be watching out for, and in particular, when we think about the policies that are likely to come as it relates to having new presidents in place, we want to pay attention to a few key things. One of those key things are the tax incentives. Okay, and this is very much focused on the aspects of from an investment perspective, and from specifically from the angle or the lens of folks interested in real estate investing. But when we talk about tax incentives, lower capital gains rates may benefit us as real estate investors. And so, considering, and this is not, by the way, I must preface this again, this is not any endorsement of any policy. This is just simply speaking out some objective information about what we are seeing here and what this may mean for us from an investment standpoint. We'll let the pundits and the talking heads, decipher this and talk about what's good or bad. But let's frame it for us. We will focus on what these things and try and translate it for the purposes of understanding our approach as investors. But lower capital gains rates may benefit real estate investors because if you consider leveraging tax advantage accounts like self-directed IRAs, for example, and investing in real estate, or solo 401ks like what I use in particular to invest in real estate. These are great things. We'll talk a little bit about depreciation later on, and how depreciation and passive losses that offset passive gains is something that we as real estate investors want to be looking out for to take advantage of. Deregulation. Now, deregulation, the relaxed regulations could, stimulate investments in some areas. So, when you can explore diversifying into less correlated assets for portfolio balance, this is really important. And when we talk about less correlated assets, we're talking specifically about assets that are correlated to the stock market, alternative investments like real estate and other types of, and private equity real estate in particular, that we focus on, and other types of private equity investments that are not correlated to the markets, have less exposure to the volatility. And as it relates to deregulation, whether that deregulation is favorable for that investment or not, you are invested in an asset class that will be able to withstand and have provide some more stability in in your portfolio to keep it balanced and growing. When we think about infrastructure development, there's been a lot of talk about the failing infrastructure of this country, and needs for roads and bridges and tunnels and airports and all of the things that may be able to not only stimulate the economy but also provide valuable infrastructure around the real estate assets or in the assets directly themselves. And so maybe there's some investment opportunities there to look out for. So increased funding may boost construction, as an example. And so if you're evaluating, this idea, and then there have been discussions about, oh, hey, there's a need to be able to improve some of the infrastructure developments around the country, or we need to make more investments into these areas to build things out. Be on the lookout and be thoughtful about how to target those types of opportunities where value can be added in some of these emerging markets that could potentially provide some higher returns. Many people should recognize that this word, or these term opportunity zones. And so opportunity zones are typically, there's been a lot of talk, or maybe you've heard the word gentrification, but there's been a lot of growth and development in certain markets. I happen to live in the New York metro area, and I remember a time, commuting down, to New York City and to Brooklyn, where, Brooklyn was not like that, this ideal place to be in certain parts. And fast forward 20 years later, Brooklyn is probably one of the most desired places to live, and definitely in the boroughs around of New York City, but certainly in terms of for young people looking to have access to a major city, Brooklyn ranks up there high. And in places where there's been opportunity zone development, where dollars can flood into those areas where businesses want to be, where the population makes sense, and where there's an opportunity to grow things. Opportunities can zones, are targeted there, and governments and municipalities focus on their dollars on these opportunity zones to be, and dollars follow those things because they typically come not only with favorable returns, but also very good tax incentives. So continued support for these underdeveloped communities to transform communities and grow and build neighborhoods, can be very important. And this is great for being able to help people invest strategically for those tax advantage investments that I was speaking about just a moment ago. Now, and then lastly, of course, the Fed, as we know it, is a non-government agency, and however, they are a big influential player in the financial marketplace, and setting different rates and around interest rates, and how that influences not only the financial markets and treasury notes and bond yields, and all of those different things are based off of policies of the Federal Reserve and their Congress and conference that meets on an ongoing basis to be able to help control the financial environment and inflation and growth and all of the things that economies are very much interested in. And so everyone is aware of the fact that between 2022 and mid 2022 and late 2023, there was quite a number of interest rates hikes that really negatively impacted, some investors that were out there. It slowed down the markets. It slowed down development. It slowed down transaction activity because the cost of borrowing got substantially higher. And as a result of that, the Fed was looking to be able to lower It's lower, lower or help to cool off inflation. And so these lower rates, the idea and what has been suggested in some actions that we've seen of late is that interest rates have started to be lowered by the Fed, and they're taking very calculated assessments about the marketplace and to be able to lower interest rates to stimulate the economy in a way that helps to get dollars off the sidelines and back and invested into stimulating the economy in the areas that they're interested in seeing it go. And so these lower interest rates could help to incentivize borrowing. If borrowing costs and that leverage or financial leverage that we can get, it becomes more affordable, and then that those dollars being invested into new assets like real estate can create better favorable returns for the investors, then that activity you would expect to see increase. But if things don't go in the direction that everyone is anticipating, then there may be some concerns that things will remain flat, and they'll be watching other areas to see what will help to stimulate the economy in the direction that they want it to go. So let's talk a little bit about thriving during presidential transition. So uncertainty about policy changes, right? Presidential transitions bring uncertainty about future economic policies. And so investors often respond to potential shifts in tax policy, regulation, and trade policies. Even the policy of change can ultimately lead to market swings as investors try to anticipate which industries will benefit from your or face challenges. So as everyone's listening and watching what's going on, some people, for example, you've seen big shifts. I think that the news this week, and we're recording this in mid-November of 2024, the news of this week has been how, wow, look at how much crypto has gone up in just a week since the announcements, or since the election has been won. And if you think about this, what does that mean? And you look back at some of the statements and positions of the president-elect have been very favorable to the crypto markets. And so when you think about those things, then you see a run up in some of those things. But just as quickly as things have run up, if for those industries that have less favorable opinions or policies from the incumbent, or excuse me, from the incoming president, then that may have a negative impact on those things. So investors are on the lookout for those things, and it's important to be mindful of those things. So shift in investor sentiment is another thing to look out for. So what do I mean by that? Investor sentiment can fluctuate based on new administration's agenda. Some industries like energy, think about oil and gas, or solar was big in the outgoing administration. Oil and gas and fossil fuels is big on in the incoming administration. Where do you think that it makes sense to place dollars? Perhaps these are things that people will calculate. Perhaps there will be a continuation of investment in renewable energies based off of the influence of some of the people that will be in the cabinet, like Elon Musk, or some of the or at least influential to the president. And then there may be also there's also some geopolitical considerations as it relates to solar, and who wants to be the world leader in renewable energy. Do we want to relinquish that to China or to other countries in Europe, or do we want to be the leader in manufacturing and producing these things as a strategic competitive advantage? These are all things that may influence investment dollars and investor sentiment. So some industries like energy, as example, or healthcare may expect favorable or unfavorable changes, leading to reactive buying or selling, and that the market often moves based on perceptions of what policies will mean for different sectors of the economy. And so then let's talk a little bit about speculation and positioning. A lot of people are going to, lose or make money, on speculation. And if you think about it, as savvy investors, you know to be very thoughtful in what you are doing and what you are investing in it. But I can tell you that not all people are very thoughtful about their investment approach. In fact, they'll just go off of tips from someone else that said, "Hey, I think you should go buy some crypto today because it's going up." And then everyone has had that experience. It's very rare that you go chasing dollars like that, and things continue to run up as anticipated. Instead, you get hit with some sober reality, and your investment dollars that you're chasing because you're speculating, or trying to position yourself, don't necessarily work out because you did not make a database decision. You're just trying to follow a speculation or a trend. So traders and institutions often reposition their portfolios based on anticipated policy impacts. So they may shift investments into perceived winning sectors, or hedge against potential losses, increasing short-term volatility. So this repositioning is driven by speculative behavior rather than fundamental economic changes. There's also the media and public opinion. So presidential transitions obviously bring a tremendous amount of coverage from media outlets, which amplifies the public attention on political decisions. Excuse me. So this could be, political decisions, that some view as favorable or not. All of the news reports and political commentary can lead to a heightened market sensitivity to rumors and predictions, during driving volatility, even if changes are speculative or uncertain. Again, think about how just the words of certain people and how words are so carefully chosen. We talked about the Federal Reserve earlier. Jerome Powell is very choiceful about the words that he speaks because he knows the influence that he has on markets, and how those words could lead to volatility or not. And then others who may not be as measured in what they speak about could say some certain things, maybe intentionally or unintentionally, to manipulate markets and to cause things to go up or down. And if you are someone who is tied to those things, and you're riding that wave, that's not necessarily a great place to be in. And then economic and global policy impacts. With the new administration, economic policies may be altered, impacting interest rates, trade agreements, and government spending. So everyone's heard about the idea of tariffs, and NAFTA and NATO and all these different types of things that exist. These are things that certainly from an economic and geopolitical perspective will have an influence on what we do and how we do, and how that impacts it could have an impact on our personal economy. So this can have ripple effects on the global markets, leading to increased fluctuations as both the U.S. and international markets react. Remember, we're in a very interconnected world now, and so the decisions that are made and the influence of the United States has tremendous impacts, and that those impacts could in fact lead to very volatile markets that we need to be mindful of. Policy transitions and timing. So even when policy direction is clear, new policies do take time to implement. And so this transition period can lead to some market uncertainty as investors basically look at reacting to both current policies and anticipated future changes. This overlap can ultimately create temporary market instability. So these are all important things for us to be thinking about here. And volatility during a transition period often reflects temporary uncertainty. One of the things that I know, like as an investor, is that volatility also creates opportunities for wealth generation in particular. There's a famous quote by Warren Buffett, and I'll paraphrase it. It goes something to the effect of, be fearful when others are greedy, and be greedy when others are fearful. And so, if you're thoughtful about things, you can, and how you approach it and position yourself and keep your eye on the prize, so to speak, this is an opportunity to keep yourself in a very favorable position. So, once the new administration's policies and priorities become clear, markets typically stabilize and adjusting to the new political and economic landscape. But these are things that definitely may have an impact on our our personal economies. So what are some strategies for passive real estate investing? Well, you guys know I talk a ton about a few key things: cash flow, leverage, strategic leverage, as I call it, with as it relates to using debt or leverage to acquire investments and the investments that we're in, and strategically, and doing it in a right way to present a favorable opportunity for you as an investor. And then talking about value add investments. What do we mean by that? There's natural appreciation that happens in the market. What about forced appreciation? We'll talk a little bit about that. And then market diversification, which I'll expand on as well. But when we think about focusing on some of these key strategies, the top thing to focus on from a real estate perspective is cash flow. And so, cash flow is essential for providing steady income, particularly during economic downturns or volatile markets. So, for passive investors, you get to benefit from consistent returns without relying on just, property appreciation. I remember, everyone, or many of you may remember, back in 2008, or just the run up to 2008 and the years prior, there was so much noise, going on about the real estate market. And at that time, it was a lot very speculative market, and a lot of people, investing in places where they heard that a market was blowing up. I have people in my life that I know were just chasing opportunities in Atlanta, Georgia. I know people that were chasing opportunities in Las Vegas, was a very big booming area at that time, and so many other spots. And then when only for a few years later, when you are investing for appreciation alone and not cash flow, that's a very dangerous proposition, because when the property isn't cash flowing, then you have a problem with servicing the loan. And so, focusing on appreciation only it is an investment strategy, but it's a risky one. You want to be focusing on cash flow, and cash flowing properties generate rental income, helping you whether the market fluctuates or not. um, a strong cash flow can actually provide liquidity, allowing for reinvestment opportunities. So as that cash flow continues to come in and get generated by the property after all the expenses are paid, then you have cash flow, and that cash flow can actually be put to work in other investments. I have to emphasize the importance of due diligence when you're selecting these properties that you're investing in. And you want to be investing with folks who have proven track record, and that know what they're doing, so that you can be able to hitch your wagons to them, so to speak, and take advantage. When we talk about leveraging debt strategically, we want to talk a little bit about low interest debt can actually be something that helps to amplify returns by increasing purchasing power while keeping financing costs manageable. So what we're looking to be able to take advantage of as investors are favorable interest rates to finance these acquisitions. So I want to make sure that people know that whether that's fixed interest rates or that is some floating interest rate, or and if it is a floating interest rate, is there an interest rate cap that exists to be able to have that asset to make sure that that asset isn't vulnerable to interest rate fluctuations in a negative way that put the property at risk. Um, these are all important considerations, but I would caution anyone to say that if it doesn't have fixed interest rate debt, then I'm not doing it. That's certainly a thought process, but one of the things that you want to be really thoughtful of is understanding the strategy of the particular investment and which financing option is actually favorable for the investment that you are getting in. So smart leverage allows investors to hold on longer with higher income potential, and managing debt responsibly is essential during this time. So prioritizing cash flow to ensure that the cash flow is generate enough cash flow is generated not only to manage the expenses of the property, including the taxes and the insurance and the principal and interest, but also to pay a dividend or distribution to the investors. So then let's talk about the targeting value add investments and why that matters. So when we talk about value add strategies, enhancing the property value by doing renovations and increasing the rental income and being able to help the force the appreciation. This is something that is really important. So what's important to know is that real estate in general typically appreciates in value about 3 to 4% annually on average throughout the US. But in some of these opportunities, you guys have seen it on the single family home side. You've seen the shows on HGTV where there's a some investor or house flipper who's gotten found a dilapidated house. They tear it up and they fix it back up, and then that house that they bought for 100 grand or 100K is now worth 400K, and they did that through forcing some appreciation in that home just through improvements to it. Now, that is considered value add, and if you take that idea of on one single family home, that same concept is what is applied to large multifamily projects, or perhaps it's on a self-storage facility or some other real estate asset where the asset can be improved to be able to generate or increase the income of the property. So being able to seek properties that could benefit from either minor renovations or some operational improvements, these are things when you're looking at different deals that may cross your desk, you want to be thoughtful about those things. So sometimes when projects are being executed, it could be simple upgrades, like modernizing interiors or improving some of the amenities, and or just simply being able to assess whether the rents that you are charged that the property that you're acquiring or that you're investing in, whether the rents are actually at market rent or they're below market rent, and is there an opportunity just simply to bring the rents on a per unit basis up to the market rent that is happening throughout the marketplace to increase the value and the income of the property. These are all things to consider as it relates to that. And so value add properties provide more control over returns, as they depend less on market appreciation and more on property improvements, either operational or through otherwise. And then finally, I'll talk a little bit about market diversification. So why is this important? So geographic diversification reduces exposure to economic downturns or disruptions in any single market. I know, and I pick off on certain markets often, but if you think about Detroit. during the great financial crisis. Everyone knows that Detroit and Michigan and some of the surrounding suburbs were very heavily reliant on the auto industry. And as a result of that, when all of the car manufacturers and institutions were failing, and the government had to rescue the auto industry, there was a lot of hand wringing over this, but there was a lot of damage that took place as well, because you had a number of different of companies that were very much reliant in industries that are just heavily related to that industry and the car and manufacturing business. Now, fast forward years later, Detroit actually has gone through quite a bit of a renaissance. So they're not only an auto focused market, but they also have a place that is very much tech influence and a host of other industries that continue to grow and emerge from there. But you want to be able to invest in a mix of markets with different economic drivers. So in addition to the Detroit and how they've transformed, and but through their lessons learned, think about what's happening in Texas, in particular Austin. You have the tech industry moving there. Everyone knows New York for finance, but New York is a very diverse marketplace as well. This is very important. So diversified portfolios are more resilient ultimately, and they protect cash flow and stability. If you put all of your eggs in one basket, whether that is, putting all of your eggs in the financial basket of the stock market, you have to realize that there's a substantial amount of risk to that, and having some diversification, not only in your portfolio balance, but also in the assets and the areas that you're investing in. When it comes to some of these real estate investments, it's really important, and you want to be investing in the places and in the markets where it makes the most sense, and that the where it makes the most sense, or where the fundamentals are true. Is the market growing? How is the job growth? How is the population growth? How is the demand for housing? What is the median household income down to the zip code? What are the schools like in the area that you're investing in? All of those things are important things to be thoughtful about when we're thinking about the markets that we're investing in. And then we want to think about prioritizing tax efficiency. So why does this matter? Real estate offers powerful tax advantages, and many people know this, but I love to reinforce this point. There's very few asset classes that provide as positive or as favorable tax advantages as real estate. The next may be the energy sector, which is with oil and gas and those types of things, but real estate has really powerful tax advantages that ultimately can help enhance returns for passive investors. So this is one of the things that makes it really important for you to consider this as a key part of your wealth building strategy. So what we're talking about here is being able to, to look at real estate that allows us, for deductions like depreciation, which I'm going to talk a little bit more about on the next slide, which can help offset taxable income. Consider using tax advantage accounts. For me, for when I talk about investing in real estate, one of the things that happened with me along my investment journey is I ran out of liquid cash to invest in, to invest with. And that quickly led me to, okay, where do I go to tap into money, until I realized that I could also invest in real estate with my retirement account. I just had to get my money into a self-directed retirement account that I can then invest in what I wanted. And that's one of the ways that I was able to continue to invest in real estate even after I tapped out of my liquid cash and could tap into some of my retirement funds. So just a couple more slides left here, and I'll be quick on the next couple. So let's talk a little bit about tax efficiency in real estate. There are a number of tax opportunities, as I was just drilling home on the previous slide. But as a passive investor in commercial multifamily property investing, tax efficiency through depreciation in particular can be a big advantage enhancing your return. So what do I mean by that? So there's something called a depreciation deduction. And when you invest in a multifamily property through a syndication or a fund, for example, the property's value minus the land value is depreciated over time. So although the property may actually be appreciating in the market, and as I was describing earlier, what the IRS does is that they allow a paper loss through what we're talking about through this depreciation. And that's typically over 27 and a half years for residential properties, which include multifamily properties. And so this idea of bonus depreciation and cost segregation, this is where the magic really happens. So many multifamily properties undergo what's known as a cost segregation study, which breaks down the property into its components that can be depreciated faster. Things like appliances or the roofing or the landscaping, and this strategy actually often allows for the operators or the syndicators to take advantage of what's known as bonus depreciation in the early years, which creates a large paper loss that ultimately gets passed on to all of the investors. Okay. And then what happens for the passive investors that they get to take advantage of what's known as a passive loss to offset their passive gain. So let's talk a little bit about this. So as a passive investor, you're going to receive your proportional share of these depreciation deductions, which basically may be more than your cash income from the property in the early years. And so this creates what's known as a quote passive loss on paper, which you can use to offset your passive gains from investment or of other passive investments. So let's translate that. If you make $25,000 in cash flow in an investment, but you have a paper loss through the bonus depreciation of $25,000, that $25,000 paper loss offset your paper gain and wipes out the you won't pay any tax on those dollars, so that money comes to you tax free. That is the power of the bonus depreciation and the passive losses and things that you need to be thoughtful about as an investor, and why real estate investing is such a powerful asset class to invest in. So if your passive losses exceed your gains, the ultimately those losses can sometimes be carried forward. So there have been, for me, for example, there have been times where no property sold in a particular year, and so that I don't lose those passive losses. I can carry them forward into future years. And so when the properties that I'm in and the investments that I'm in, when they do sell, I can use those passive losses and apply them to any capital gains from the sales proceeds from those investments to wipe out those gains, and then I can receive those funds or tax free. Tax free, excuse me. So this continues ultimately to reduce the taxable income from passive sources. So this is a huge tax efficiency that lets you keep more of your investment income. When you're investing in the financial markets, there may be some clever ways that you can play around with, but largely those are capital gains, and those are going to be taxed at the highest rate, and or put you in a different income bracket, and those types of things are not going to be favorable for you more than likely from a tax perspective. And these are all things that you'll of course consult with your own CPA to discuss how this type of strategy can benefit you. But and you can challenge these things with your CPA to help them understand. If your CPA does not know about these things, I would suggest getting another CPA, so the one who does know about how to take advantage of these types of investment opportunities to position you in a favorable way, because that is what their obligation is. These are things that are important. So even if the property, to wrap this up, is generating cash flow that is positive, income, the depreciation reduces the taxable portion of that income, potentially making it a tax-free or tax-deferred. So this is a powerful tool. Depreciation in multifamily properties allows for passive investors to grow their wealth by keeping more cash flow tax-free. And this is something that when you hear of concepts like the velocity of money, this is something that you can take advantage of and allow you to reinvest those dollars for compounded interest, which I know all of you have heard of. So then let's just wrap this up with the last couple of slides here, and this about building a family legacy through real estate investing. So when I think about myself personally, building a family legacy through real estate isn't just about accumulating wealth, but it's about creating something that's lasting for my loved ones, and you should be thinking about it the same for your loved ones, that can provide security, stability, and opportunities well into the future. So real estate stands out because it's a tangible, appreciating asset that you can pass down for generations. And when we invest in real estate, we're not only thinking about our immediate returns, but we're building something that will continue to grow and benefit our families long after we're gone. And unlike many other investments, real estate gives us the control and leverage to influence value, and whether we are choosing locations wisely and enhancing properties and or holding assets through different market cycles. There's so many different things to consider there, but real estate can also offer cash flow, as I mentioned before, and that creates a life cycle for your family today while building wealth for tomorrow. Each investment decision has the power to provide educational opportunities, capital for new ventures, and even charitable contributions that reflect your family's values. So I truly believe that by building a legacy in real estate, we're creating a legacy of financial empowerment. And this isn't just about the dollars, as I mentioned before, it's about independence, that resilience, and knowing that your family has resources and options no matter what life throws their way. So ultimately, we have the ability to set up our families for futures that reflects our hard work and dedication, and that's a powerful gift to pass on, again, regardless of who is in office. So what are the key takeaways that I want to leave you with today for empowering your financial future? It's about taking action. Make sure that you focus on long-term growth as a strategy here. Real estate investing rewards patience and strategic thinking. So stay committed to your goals of what you're trying to do. There may be things that don't go ideal, but that doesn't mean that you have to abandon ship. Stay the course. Continuous learning. This again, I cannot say enough the how much I appreciate you guys taking the time to join me here this evening. But what it signals, it's not about me, it's about you and this continuous learning. There are so many things that you could be doing right now, but you're here with me learning and continue to expand your knowledge, have paradigm shifts. This is important, and the market evolves constantly as well. So stay informed about what's going on and adapt your strategies as needed. But make sure you just stay focused on those things. And then community support. Continue to come to places like this, network, share, reach out to folks, reach out to me, share your experiences and learn from each other's successes and challenges. There not everything is all roses through all these things, but with experience and knowing how to navigate, you'll be able to navigate through challenges that you're anticipating, that you can control. And then when things are going great, that of course that's a great feeling, but know how to navigate through each situation. And then finally, take action. You know, the other saying that I've learned over time, and that's something that really resonates with me, is the idea of knowledge is power. You know, what what someone said to me that has stuck with me is that knowledge is not power. Knowledge is not power until it is applied. So make sure that you're taking action. I will not bore you with more and more quotes, but the best time to start was yesterday, as someone once said, but the second best time to start is now. So you can take advantage, begin your journey, start taking these steps. The transition that we're going through and is a perfect opportunity for that reset and for you to be focused on the things that are most important to you, which is your family and your family's well-being and for yourself. So thank you all again for taking the time to engage in or to learn a little bit something and to hear a different perspective tonight. If you're interested in talking more about wealth mindset and real estate investing, reach out to me, as I mentioned before, Chris at boostmycapital.com, or scan the QR code. I'm looking forward to speaking with you. So with that, I will go ahead and stop presenting, and we'll open it up for any Q&A. And for those of you who are watching online, thank you. And I'll see you again next time. But with that, I'll stop the recording.